welcome to Currency Exchange, a NatWest podcast series all about foreign exchange markets. I'm Brian Daingerfield. I co-head G10FX strategy at NatWest here in the US. And today I'm happy to be joined once again by Paul Robson, who co-heads G10FX strategy for us at NatWest over in London to talk about all things US and UK this week. We happen to be recording as President Trump is announcing the details of a framework trade deal between our two nations, Paul. So really good timing to be talking about FX and trade policy and central bank meetings. So thanks very much, Paul, for joining.
Well, thanks for the invitation again. Like you say, we've definitely picked a day with lots of headlines coming across the screens, just coming in to record today's podcast. There another sort of wave of headlines. It'll be interesting to see ultimately what the matter. But yeah, we're looking forward to discussing the Bank of England and those trade headlines, and obviously lots of things going on in the US as well.
Yeah, absolutely. So let's start with the Bank of England. That's certainly front of mind for me this morning. You know, the decision is just out as of a few hours ago. What was the impact there on sterling, and what did the Bank of England decide today?
Yeah, so sterling was a little bit stronger on the decision. It's a little bit difficult to unpick everything because, as you say, we've also had the various trade headlines, and sterling has been reacting to those, not significantly so, but trying to unpick sort of the primary driver. But I think a relatively sort of hawkish sounding Bank of England decision was mildly supportive for the currency. In terms of the decision, I don't think there was very much doubt about that in terms of the surveys and market pricing. Both were very resolutely behind a quarter point cut in the policy rate from the MPC today. But the decision was always going to be about the guidance, all about the hints about future policy in terms of the forecast, but the actual explicit guidance that the Bank of England give, and also always seems to be the case, doesn't it, Brian? It's that vote count that everyone tries to dissect as well. And the guidance and the vote count were just slightly more hawkish than expected. I think certain parts of the market were really geared up for something really quite dovish today. You'd had growth expectations softening, inflation expectations, or sort of energy prices also a little bit lower, and there was market chatter about whether the Bank of England would lay the ground for back-to-back quarter point cuts, so one in May and one in June, and there really wasn't very much to support those views at this point. They kept to the guidance, gradual easing in monetary policy was sort of core guidance that remained unchanged. And in terms of the vote count as well, I think the market surveys that I saw running into the meeting had a vote count of 8-1, one person voting for 50 basis points and the other 8 on the committee voting for 25 basis points. But in the end, you had a three-way split in the MPC. So you had 5 voting for a 25 basis point cut. You had 2 voting for a 50 basis point cut, but you had 2, and importantly, one of those being the Bank of England's chief economist voting for unchanged rates. And I think overall, it's for some, and then for the members who had voted for the 25 basis point cut, it was said for some members it was finely balanced. So the decision could have been a little bit closer. I think it's really just comes down to still uncertainty about inflation. I think the Bank of England is relatively confident that inflation's coming lower, but they have traditionally been rather backward looking because inflation had been a bit more persistent than they expected. It rose more than they expected, and they just want to be sure, some members want to be sure that inflation's coming down. And within that, the labour market is often key. And unfortunately, at the current time, confidence in the actual validity of the labour market data is somewhat lacking. We have a few indicators. So I think they just want to make sure that the recent blip up in inflation comes low before voting. But on balance, a hawkish central bank meeting.
sterling has regained some ground against the euro over the last couple of days. How are you thinking about the Bank of England and its stance, sort of maybe not validating market dovish expectations as we think about how this impacts sterling as we look ahead over the coming months?
Yeah, I think the first point to make is that I don't think there's a really deep theme within sterling at the moment that you can sort of hang your hat on if you like. I think it's being driven largely by what's happening in the US and the dollar and the sort of fallout from that. And as we spoke last week, we talked about capital flows, didn't we? And I still think that that's really important. But today's market reaction does show that interest rates are still important, the difference, and quite often it's the level at this point, not necessarily the change in interest rate yields that are important for the currency. And this was obviously one of our big things, wasn't it, Brian, at the beginning of the year or at the end of last year when we looked into 2025 about the Bank of England being a cautious cutter. Sterling and the Bank of England would keep a sort of king carry, if you want. Carry was going to be important, and that's why we had expectations that sterling would outperform, and ultimately that's what we've seen. So looking forward, if the Bank of England stays a cautious cutter, then that's generally going to be supportive. Most obviously, I think, against the euro. So we might see some upside for sterling euro. But I think the big thing for sterling dollar will be what's going on in the US. So it's the dollar side of that exchange rate that matters, and to what extent capital flows out of the US. And I think one of the big talking points at the moment is asset allocation in markets.
Yeah, I definitely want to get into those discussions about sort of short term versus more medium term questions for the dollar, because the Bank of England's not the only central bank that didn't validate expectations for maybe a shift in the dovish direction. But before we talk a little bit about the Fed, I do want to ask you about this trade agreement that we have between the US and the UK. Certainly, we are recording this as those details are coming out. But I did want to get your snap reaction about how you're thinking about this as we should be incorporating it into sterling specifically. Is this something you think is going to be a major game changer for the currency?
I don't think it is, but is it a negative? No. Is it a positive? Yes. I think it just reduces some of the uncertainty. Is it important for various sectors of the UK economy? Undoubtedly. Is it important from a macro level? Perhaps less so. And as you say, the devil will be in the detail, won't it? And we've got to have to look through all the headlines that we'll review most likely after this podcast. But trading goods between the US and the UK was broadly in balance. And I think while these are important developments, I won't be rushing to change our forecast for sterling against the dollar or against the euro. I'd be really looking forward to hearing what you think about the broader impact of this, what it might mean for other deals and the sequencing, and that's going to be super important, I think, for currency markets. But before we get on to that, like you say, bring it back to central banks. We had the Fed. It's very similar, isn't it? The market seems very of the idea that the Fed cuts aggressively. I know you and the team have been much more cautious on the Fed, but how did you see the Fed decision? Importantly, does it change anything for the dollar for you?
Sure. So I think the market was expecting this to be effectively a placeholder meeting. And the non-farm payroll report on Friday, I feel like really clinched that in the minds of the markets. That it's pretty clear the Fed is waiting for the data to give them the green light to either, to cut or not. And the data, the hard data especially, are not yet giving them that green light. Now, I think it's very fair to say that a lot of the data so far are either not yet incorporating potential impacts, or even as Powell sort of flagged himself, that some of the volatility around trying to preload purchases, preload investment, preload imports ahead of expected tariffs are potentially warping some of these near-term data and in some cases strengthening them. So still think it's likely that we see some payback from that preloading as we get further into the second quarter. But with the hard data not yet giving the Fed, warning signs that we need to be moving quickly, it seemed pretty likely that the Fed was going to be unwilling to move in a more dovish direction. And to be fair, this is where the Fed has been. The market has been more aggressive in looking forward to potential weakness and pricing in a more clear pivot to growth. And I think what the Fed delivered was not unexpected, but nevertheless yielded a meaningful rally in the dollar. What really stood out to me from the Fed's communication was a discussion of whether they would preempt a slowdown or whether they felt they would be in a position to preempt a slowdown with interest rate cuts. And Powell said effectively that this is not a situation where the Fed feels like they can be preemptive. And I think that's something that the market took as quite hawkish, even if the market generally expected this wasn't going to be a moment for the Fed to, throw the dovish doors wide open, that maybe there was some room for incremental dovishness and some acknowledgement that these risks could lead the Fed to moving into a more proactive stance, a preemptive stance. And Powell tried to push back against that idea that they would be in this position because there are these upside risks to inflation, excuse me, that come alongside the upside risks to the unemployment rate. And Powell mentioned that uncertainty around both were, had risen at this point. So as we take all this together, I think it's clear that the Fed and the Bank of England are among the more cautious approachers in terms of shifts in policy. And look, if we were at this point last year, this would be a very potent cocktail for a stronger dollar because so much of the dollar price action was heavily correlated with the specifics of carry and the specifics of front end interest rates. What we've seen more recently is that the dollar's relationship with front end interest rate developments has shown some signs of weakening. And a lot of that, I think, is linked to the specifics of higher market volatility, the concerns around growth, and the concerns around foreign investor approach to whether it be US asset holdings or at least the FX hedging component of those holdings. That has shown some signs of maybe weakening these correlations between front end interest rates and the dollar, which until really the inauguration of President Trump had been extremely strong. Effectively, the only game in town was if the Fed is staying more hawkish and the rest of the world is adjusting, maybe more open to dovish pivots thanks to these growth risks, then that is a dollar positive input. Now, those relationships are a bit more muddied than they had been in the past. But the dollar responding to this Fed meeting in a positive way. And so I think ultimately this is going to come down to the economic data that the Fed says they're in no hurry. And I think the growth data are going to be really important here because either the growth data start to more materially slow and push the Fed in the direction of easing, or they continue to hold up here and maybe push back a little bit more on those market expectations. But what we'll be watching here very closely is if some of those previous correlations that had been very strong start to show signs of reconnecting, and if so, that could be something that provides a bit more upside to the dollar. Although we continue to think that these medium-term questions are still very relevant and they still point in the sort of downward direction for the dollar.
Yeah, it's certainly very interesting that you were saying coming into this week's central bank meetings, sort of coming to the end, and having both the Fed and the Bank of England relatively cautious on cutting interest rates when some of the high frequency data have been really quite weak. It will be interesting to see, I think, as you described in recent podcasts about whether the soft data, so things like survey data, consumer confidence, feeds through into weaker hard data, and maybe that will shift the needle for both the Bank of England and the Fed. But lots of uncertainty given the change in US policy in terms of trade, foreign policy, and economic policy. Picking back up on that trade policy and tariffs, we can never leave it for very long. So maybe we'll just finish up today by one question about what did you think was the read across from your initial take on the UK US trade deal headlines that were flashing across the screens as we started recording.
Yeah, I think for global risk and for global markets and for the big dollar, the question about the US UK trade deal was, I think, less about the specifics and more about what that deal suggests the broader picture could look like for larger trading partners, larger economies, those with greater direct exposure to the US. And we were looking at a couple of important factors. Was whether there would be specific purchase commitments. It appears that there is a specific purchase commitment related to aircraft within this deal. A second one was about foreign exchange. This is certainly not an issue for the US and UK necessarily, but questions around currency interventions and FX manipulation. And certainly we know the Trump administration has in the past suggested they may have preference for a weaker dollar within their strong dollar framework. Whether or not there'd be specific language on currency valuation, I don't feel like that's something necessarily in the US and UK discussion, but would certainly be something that could feature in other discussions, most notably with China. And maybe the last point would be on the specifics of what concessions were the US willing to offer on the other side of this. And I think here is where we have seen some meaningful input, which is that it appears that this deal between the US and the UK has not led to a reduction in the 10% universal minimum tariff facing the UK as part of the reciprocal regime. So if you recall, the reciprocal regime includes a 10% minimum tariff and then additional tariff rates on top of that for sort of worst offender countries, essentially. Because the US and the UK have effectively a trade, there aren't massive trade imbalances, the UK was only subject to the 10% universal minimum tariff. For other larger nations, those reciprocal tariffs do point towards potentially higher levels of tariffs after the 90-day pause. So I think the open question was, would the administration be willing to negotiate tariff levels to move below the 10% universal minimum tariff, or was that something that was going to be stickier? I think what we've seen from these initial headlines, and certainly a lot could still change here, but it seems like the US administration may not be willing to negotiate below that 10% level. And it sounds like what the UK got from concessions from the US was on sectoral tariffs, specifically on autos and on steel, appear to be where the UK was able to win concessions from the Trump administration. So we take all this together and say, if this is the template for what future trade deals will look like, there's, I think, some good here and maybe some not as good here. The good here is that we were able to get a point where we have a near-term template for what a package looks like that includes some de-escalation from the US side and some concessions from the UK side. Maybe the more concerning piece is that the concessions that were offered by the US at the end of this are maybe not as large and not as wholesale as maybe we had hoped. And so when you think about Japan and the EU and China especially, if the path at the end of this is still meaningfully higher tariffs, say the universal minimum tariff of 10% as maybe the minimum, maybe that reduces the willingness to continue to negotiate. And not necessarily that they would not be looking for further negotiations, because they certainly want to lower the potential tariff hits. But what we're hearing from the EU and Japan side especially is they're not just looking for piecemeal relief. They want full tariff relief at the end of this. And so those discussions, a lot of what we hear in the media, or at least the speculation in the media, is that the discussions have been difficult because of that specific issue around how much concessions that we may get. Now, of course, the market is, looking forward to important trade talks taking place between between the US and China this weekend in Switzerland. I think the UK trade framework that we have in place now is not a great template, but I think it does give the market a roadmap for Trump to potentially pursue unilateral de-escalation. Essentially, it seems like from the changes, exclusion of tech, for example, from the China tariffs earlier, previous delays in the 90 days for some of the reciprocal tariff regime, for example, it seems that Trump has been open to concerns from businesses, U.S. businesses, and those concerns on the level and persistence of U.S.-China tariffs have been large. And so I think that the Trump administration may be looking for an opportunity to de-escalate without necessarily getting a deal in hand. And certainly the market is looking forward to the weekend talks as maybe an opportunity to sort of unlock that potential unilateral de-escalation before a deal comes into place. But we'll be watching specifically the details. So, the tariffs specifically on China, there's a number of different sort of rationales and reasons for why these tariffs are in place. A portion of that is the reciprocal tariffs, which for most countries have already been delayed. A portion of that relates to China-specific retaliation. in terms of China matching the 1-for-1 in terms of the reciprocal regime. We've had this sort of constant escalation, re-escalation that pushed us to this 145% level. And we also have 20% of the 145% is related to fentanyl and specifically related to border issues. That's also wrapped up in the questions about de minimis. And so as these talks go over the weekend, if there is room for de-escalation, I think what will matter is which of these tariff pieces is actually up for potential de-escalation. So if this is a discussion on fentanyl and there's a concession made on fentanyl, maybe that means that the fentanyl-related tariffs can see some relief, and that would be the 20%, which is a relatively small piece of the current basket. Maybe we could see larger de-escalation if we see China maybe stepping back a bit from some of its retaliatory tariffs as well. But I think the markets are very optimistic that this weekend is going to give the Trump administration some room for de-escalation. I think that's a fair point. But I do think that markets should be mindful that the administration shows with this UK deal that there's a limit to how much direct tariff relief they may be willing to offer in these early stages. And I think markets should be very critical of what relief might be offered and what relief may not be on the table. So with that, Paul, maybe we will wrap it up there. I know we've gone through a lot on US and UK and how that all impacts our thinking on trade deals and potential de-escalation in other major trading relationships. So thanks very much for the conversation, Paul, and to our listeners, as always, thanks very much for joining. If you enjoyed today's podcast, please consider giving it a like and also subscribing to our channel so that you can get our latest content the moment it's released. Thank you very much.